So we taped this interview just a day or so ago, and I wanted, actually, it would have been on Friday, I guess, right? There was a story, an editorial, an opinion piece in the Globe and Mail by this gentleman. His name is David Rosenberg. He's an economist, founder of Rosenberg Research. He's often quoted in the U.S. financial news as well. And the headline said he sees the Canadian dollar falling to below 60 cents or to 60 cents by as quickly as before the end of next year. So I began the interview because this was just after the jobs report came out. Now, the jobs numbers were actually not bad. I think we had 15,000 jobs were added in the last quarter. But the number that got buried in there was 55,000 manufacturing jobs lost in the quarter. So I started with that and asked if that was part of the rationale, because we've seen these numbers fall now for, I think, the last 3 quarters, for his prediction. Here's what he said.
Well, that's a very important issue. The Canadian employment number was positive and came in above market expectations, but that was really because of all the job gains that we got in youth and part-time and leisure hospitality because of the World Cup. So that was a temporary source of stimulus for the economy, but was not broadly shared, because when you adjust the employment number for FIFA, it was actually negative. And your point about manufacturing is 100% spot on, because that is the sector that is most sensitive to shifts in the Canadian dollar. If manufacturing employment in Canada was booming, I'd be telling you, the Canadian dollar should be going up. But manufacturing employment has been down in Canada 2 of the past 3 months. And in fact, the decline in June was the steepest decline since April 2020, when we were suffering from the peak anxiety around COVID-19. The manufacturing numbers, that's actually, when I'm thinking about the Canadian dollar, the first thing I go to in this report is manufacturing employment. And the decline in June was shocking. And that was the story beneath the story as far as how you should be formulating your view on the Canadian dollar.
I guess I would ask, you mentioned you've been short the dollar, you've been projecting this now for quite some time. In your estimation, how did we get here? How did we end up going from, having this strong economy to where we are right now? Was there one key moment?
Well, the strong economy was really camouflaged by the fact that we had an immigration-led population boom. When you look at the Canadian economy for years, in fact, all the years under the Justin Trudeau era, in per capita terms, real GDP was just going down. We don't have that population growth anymore because the immigration file has reversed course, and now the numbers, you can argue, are artificially weak, but they're still weak. What's happened here in Canada is this, because when you're taking a look at a currency is an exchange rate. It's one currency versus another currency. I'm not here talking about the Canadian dollar against the Japanese yen or against sterling or against the euro or against the Australian dollar. In Canada, when you're asked about the Canadian dollar, you're being asked really how is the Canadian dollar doing versus the US dollar. And that's really what most of us care about in any event. You're right. So take a look what's happened in the past year. In the past year, Canadian GDP growth is basically zero. And in the past year, U.S. GDP growth is 2.5%. When you're taking a look at where you would want to put your money to get interest, you could put your money in Canada in the 2-year Government of Canada bond and get 2.8% interest, or you could go to the United States for the same maturity and get 4.2% interest. So we don't even have to talk about, what's happening in terms of the enthusiasm between the two stock markets. And because of the bank stocks and until recently energy, Canada's done quite well. But let's face it, the whole technology, AI innovation, all that's taken place in the United States. Put that aside. You're an investor who wants to collect interest income. Where are you going to go? 2.8% in Canada, 4.2% in the United States. That is a 1.4 percentage point premium that you get in the United States. And the question is, why? Well, I told you, 90 seconds ago. It's because the U.S. economy is just so much stronger than the Canadian economy is. And that growth gap is accelerating. So insofar as a currency is a pair trade. It is comparing two different countries. And when you have one country with zero GDP growth, and one country with 2.5% GDP growth, and you get a nice interest rate pickup, the answer is pretty obvious as to where you want to allocate your capital. And it's to the U.S. over Canada. So until such time as something miraculous happens in Canada that causes our growth to catch up to the United States, the path of least resistance is going to be an ever-weakening Canadian dollar. And that was the premise of the report.
So let me ask you, I think people listening now will remember, if they've been around a while, when we could actually say the Canadian dollar is worth more than the American dollar. Those days are long gone in the rearview mirror. You make a note in your piece, I think, about one specific moment, a pivotal moment, when everything began to change. What was that?
I would say it was December 2017, when Donald Trump, with the help of a Republican-backed Congress, dramatically cut tax rates, and especially in the business sector, where he cut the top marginal corporate tax rate from 35% to 21%. And instead of the Canadian government back then under Justin Trudeau responding to that, because that was a major negative competitive hit to our economy. It's amazing how most people don't realize that we sat still as the U.S. took their top marginal rate on corporate income lower than Canada. We stayed at 26.5%. When you look at the total provincial federal blended rate, they went to 21% from 35%. We're the junior partner here. Canada is not the United States. No, we might be nicer people here. I wouldn't argue that. But the U.S. is the reserve currency. They are the bastion of capitalism, at least for now. And they're a magnet for capital. The United States is a magnet for capital. Canada has to stay tax competitive. So not only do we complain, rightfully so, about how high top marginal tax rates in Canada, how high they are here in the personal sector. Who doesn't bellyache about the fact that we spend more than half our paycheck to the government? We bellyache about that as people. But the reality is that we can't just pick up willy-nilly and move to the States. You just can't do that. You got to get a visa. You got to get a green card. It's not so easy, right? But capital moves where it's treated best, and capital can move quickly. And what people have to realize is that capital creates GDP growth, creates productivity, and it creates jobs. So I find it very interesting that when it came to the tariffs, well, in Canada, we had no problem responding to the Trump tariffs. But when it came to the other competitive hit, which was taking top business tax rates below Canada, and this is going back like 8 years, nary a response, even under this different version of the Liberal government. Not a response to that competitive hit. So what's happened since that time that the U.S. cut their corporate tax rate below our levels, and we did not respond, and we should have responded. We have recorded $300 billion over this period of net foreign direct investment capital outflow out of our country. And because I'm an economist, I know that number. So do other economists. But most Canadians don't understand, and I know I'm sounding like an economics 101 professor, how detrimental that is to the economy, that we've lost that much physical capital. I'm not talking about paper. I'm not talking about bonds. I'm not talking about stocks. I'm talking about real physical direct investment, real capital that creates jobs. And this is never talked about. Now, I'll tell you right now that had we had a different government take over, I think the Conservatives were running on a plank to cut corporate tax rates because I think they understood the situation. But let's face it, the corporate sector is not really the constituents from a voting perspective as far as the Liberal Party is concerned. How are you going to cut taxes for fat cat businesses in this country? Well, the Liberals are never going to do that. So the bottom line is that bringing it back to the Canadian dollar, is that we've had a massive, we used to talk about the brain drain. Remember all those years and years of the brain drain? Canada is suffering from a capital drain. And that capital drain has completely impaired the productive capital stock in this country, which has not grown in a decade. When I mentioned before about what's happened within Canada and the United States, and I said that Canada's got 0% GDP growth the past year, the U.S. is 2.5%. It's even more glaring than that, because productivity growth in Canada, productivity, which is the mother's milk for sustainable economic growth, productivity is running negative year over year. It's negative 0.6 to the decimal point. In the United States, productivity is 2.5%. The United States is running their economy. Almost 100% of their growth is being driven by productivity, which then leads to greater returns on capital. It's one of the reasons why their interest rates are higher than they are in Canada. Comes back to one point I made before. You're an investor. You can buy a Canadian 2-year note, as I said before, at 2.8%, or you could buy the same 2-year note in the United States for 4.2%. Yeah. What would you do? Because I'm pretty sure you want to make money. So the money gravitates to the country that has the higher rate of return on capital. And part of that goes back to how, and to me, it's an economic crime that we never responded. Now, it was out of our hands, 100% out of our hands. But guess what? The Trump tariffs are out of our hands. We found ways to retaliate. Funny, isn't it, that when they cut their tax rate below where their chief competitor is, and the United States is a big customer, the biggest customer, our biggest competitor, and they just basically undercut their pricing. And we did nothing. This is like Walmart. Walmart cuts its prices, and Costco and Kroger and Whole Foods do nothing. They just sit there and allow their market share to deteriorate. That's what has happened in Canada. Okay. And that's why the Canadian dollar is in a fundamental bear market.
I guess just to wrap up, because I'm out of time, I would ask you what your advice to Canadians is who've just heard you describe this.
Well, we're heading into the middle of July. Summer still has, call it, almost 2 months. So my advice to Canadians, given the Canadian dollar outlook, is vacation at home this year.
Mm. Leave it at that. Mr. Rosenberg, very much appreciate the time and the insight. I thank you.
All the best. Take care.
Take good care. Bye-bye.
Bye-bye.
Hello, Canada.
This is Bryan Adams Radio. Hosted by Bryan Adams himself.
We'll play a few of mine, a ton of my favorites, and some must-hear behind-the-scenes stories from the world of rock and roll. One thing about doing rock and roll so long is you end up meeting a lot of the people that you admire. Sometimes you even get to work with them. It's only love, and that's all.
Bryan Adams Radio. Now available on the free iHeartRadio app.
Everybody